Hey, real quick before we jump into this next episode, which is a lot of fun, I just want to say thanks to everyone who's listening and following the podcast. This is so much fun for me to do. I love meeting new people and talking about all the things that are related to growth. And if you're not following the podcast on the email newsletter, Exploring Growth newsletter, just go over to harvardmurray.com, click on Exploring Growth, and sign up right there. And you'll want to follow there because you'll get additional thoughts from me on each episode as each episode is published. We've had a lot of really cool guests come through, a lot of CEOs, strategists, all kinds of people. And you get to see as the weeks go on, all these different people that come through and their stories, and just super interesting. So go over there and sign up for the newsletter if you haven't. For this episode, the first probably 11 or 12 minutes is us talking about Jim's background. So if you want to skip ahead to the actual conversation about valuation in preparation to exit, then go ahead and skip ahead to about 11 minutes, 30 seconds. And that's kind of where we start our conversation. But the first half is really me talking to Jim about his background working for Bacardi and the Bacardi family as a head of global digital marketing, and some of the other things he did earlier in his career that were just super interesting, and I think sets the stage for the conversation that we're going to have. But either way, enjoy. Welcome back to Exploring Growth. In this episode, I have the opportunity to sit down with a growth consultant who has 23 years of experience in strategy, transformation, and strategic growth. Today, I'm talking with Jim Stevenson, founder and CEO of the Bletchley Group. Welcome to the show, Jim.
Thanks, Lee. Glad to be here. It's exciting.
So I have to say, I think that you're the first growth consultant I've had on the show. I just haven't found anyone that was a great fit so far. But when we got introduced, this topic of how a company can improve their valuation as they plan for exit came up. And I immediately saw an opportunity for us to dig into this a little bit. And mainly because I think at least half of my audience is going to be thinking about an exit at some point. So I'm excited to talk about this with you.
Yeah, it's a great topic. And it's something that people very often leave too late to think about. Mm-hmm. It's suddenly, I want to sell my business in 3 months or 6 months. And it's like, well, yeah, you can, but it's much better if you give yourself a bit of time and the ability to plan what you're going to do and how you're going to do it.
Yeah. Okay. Well, before we jump into that, give us a little bit of context for who you are and what kind of work you do. I know you were just telling me about the inception of the Bletchley Group and the name. You're going to have to go through that again.
Yeah, that's okay. I like it. It's a good story, so I don't mind telling it as often as I can.
Yeah, it was a good story.
I worked in construction to start with, and when I wanted to move into construction was a fantastic start for me personally. It's very commercial. When your business is making 0.4% profit, you need to be very commercial in everything you do. So it gave me a really good basis. But my heart was always in technology. And so I created my own business 24 years ago now called Bletchley Group. And Bletchley Park, where I got Bletchley from, is where Alan Turing created the world's first programmable computer. The technology then went away to Manchester, I think it was, in Ferranti, and got picked up by US universities. But it started in Bletchley Park, where the Allies needed to break the German Enigma code. And I loved that. I loved the fact that we created the whole technology industry that we know today for the purpose, and there was a physical purpose of breaking that code. And that's been the ethos of Bletchley Group. So that was where we started, but we've evolved now. Technology is still a big part of what we do, and every company that we work with, and every company in the world, to be honest. But we're much more strategic advisory now. So we help companies to find growth. We help them to understand where their next level is coming from, how they're moving forward as their business or expanding geographically or their product set. And a lot of that is fundraising and M&A, which is where how do you value your business or improve the value of your business before you do an exit comes from.
Gotcha. That's super interesting. And as I was looking at your bio, I saw an example on there of a client you had worked with in the past. I think the name is Scout 24. And it said that you had boosted their valuation from 300 million to 850 million inside of 18 months. Now that raised my eyebrows a little bit. And I was like, okay, I got to know more about this.
Absolutely. Scout 24 was an amazing company. No, it's no longer there. It's been merged a couple of times since then. It's an amazing company. And of course, I didn't do it all myself.
Oh, sure, sure.
I was the guy from Bletchley, and we got brought in to kind of help them understand that they did all the work. I
Yeah.
just brought some of the brain power and the thinking. But originally it was bought into by KKR, who paid 300 million, I think, for it. And KKR were a bit frustrated it wasn't quite growing quickly enough for them. They were obviously looking for quick returns. And through a friend of a friend, I was asked if I would go in and help. And it was, I mean, I can break this down into being incredibly simplistic, or I can tell you a story. So I'll do both. And
Whichever
I'll give you
whichever one you feel. Yeah.
well, yeah, I mean, the reality is Scout 24 at the time was essentially Switzerland's equivalent to eBay, to Rightmove and AutoTrader. Oh, you don't have Rightmove here. So it was
No. Auto
essentially a
Trader on
marketplace.
eBay. Yeah.
Yeah, it was essentially a marketplace that did everything in the eBay world.
Okay.
All houses and all the cars. They had two or three other things as well, but it was those three verticals were the main thing.
Okay.
And when I went in, they had the three verticals. They had the profit and loss for the three verticals working. But once you got below the level, it became very clear that they were sharing resources. So what you actually had was someone in charge of a P&L who didn't actually control the resources he needed to be successful. So you would get further down, and as you were building the website and the marketplace and the platform, they all had their own advertising teams, their marketing teams to get advertisers to come in. But when you got into developing the product, which was the website, they would have to vie for resources, whether it be front-end developers or user experience or designers and things like that. So essentially what I did, and this is incredibly simplistic, I restructured the teams to balance them. So that actually, if you needed a user experience and you were one of the verticals, you had the user experience guy that you needed. You had the
Yeah.
front end, the back end, so that you could control your own destiny in part of that. You could prioritize your own things. And
Yeah.
the biggest thing, and this is, I find this quite embarrassing, but I'll tell you anyway because it is valuable. The biggest thing I did was I moved people's desks. They had their own. They had their own building. It was a lovely big building. They'd invested in their own building just outside of Bern, in Switzerland. It was a fantastic building, designed. They actually had the walls. There was 4 levels. They had the walls painted by an artist yellow, and each floor had a slightly different color of yellow. So we weren't allowed to put sticky notes in the walls because of that reason. But what you found was that all the engineers were on the ground floor, all the user experience were on the first floor, all the marketing were on the second floor. And they were structured in that functional area, which is very common in organization structures to do
Sure.
that as well.
Sure.
But what I did was I moved them so that the teams they were working with were right next to each other. So if I needed to collaborate with someone, I just needed to turn around and the person I was collaborating was there.
They're right there.
I didn't need to organize a meeting next Tuesday, book a meeting room, organize everything, get everyone in the one room. I was literally just the person was there. That was the one biggest thing that happened. We moved people's desks.
It's
to
so
be
interesting
where
how
they needed to
something
be.
so simple can have such a profound impact.
Exactly, and it isn't rocket. I'm going to say it's rocket science because I did it and it was
Yeah,
genius
sure.
in my head.
Oh,
But
sure. Yeah.
it genuinely wasn't rocket science. I mean,
Yeah.
we went beyond that and we changed how they did product management and
Mm-hmm.
testing and A/B testing as a framework. We introduced that into them. We introduced doing customer flows and then adding data onto those things so that they
Mm-hmm.
could improve as they were going. But genuinely the biggest thing that had the impact was just moving people's desks so they could
I
collaborate
mean,
better.
yeah, it wasn't rocket science. You're right, but what it was a genuine outside perspective, and that's the value of a strategic growth consultant is someone who can come in from the outside with no bias and have breadth and depth of knowledge, both across industries and in their domain, to bring that and say, well, you don't see that. You could just do this. They can't see it. There's no way they could ever see it. It would take forever for them to see it. So I think that's a
Yeah.
massive value.
Yeah, completely. And it's one of those things that when you're into the weeds of your business and you're running it, and maybe even you structured the business because 3 years ago that made sense. And I genuinely believe that it probably did make sense 3 years ago. The world has changed, your customers have changed, your teams have changed, ways of working have changed. You need to keep on top of these things. And it's very often the simple things that you can change that will have the biggest impact. And
Mm-hmm.
then you're doing incremental additions onto that as you go, as you flow, and you start to see the benefits.
So I want to move to another story here, just kind of as we look through your background, because I think this all has precedence for the conversation of valuation and exiting.
Yeah.
You were at one point head of digital marketing for Bacardi. I'm sure that had to have been an amazing experience, just because I've read about the history of Bacardi and Miami and all the things that, the Bacardi family and all of that. Been down there, seen the mansion that sits on the
Yeah.
island and everything. What was that experience like being head of digital marketing?
It was, to be honest, it was probably one of the best clients I've had ever. They are just fantastic. The family members are all amazing. They are wonderful people. They've brought a brilliant team with them. When I joined them, they were going through some changes. They just appointed a new chief marketing officer who was based in the UK, but the team was based in Washington, D.C., so they wanted to move the team to London. And that was my original kind of role there. But they liked what I did well enough that they asked me to stay on, and essentially became this, I can't remember what the title was, global digital director or something.
Yeah.
And I was there for 2.5 years, based out of London. It was fantastic. Because the US is such a big market, someone from the team had to go to Miami 1 week every
Oh,
month. And I
horrible.
believe you lead from the front. It's
Yes,
a
of
leader's
course.
job to lead
Of
from the
course.
front. So, and more often than not, I spent a week on Miami Beach every month, heading
Uh,
into Biscayne Boulevard to meet with the
yeah,
team. It was an amazing experience.
that
But
sounds like a horrible
beyond
life.
that, yeah, exactly. Yeah, it's tough. Beyond that, the company itself is fantastic. The
Yeah.
products they have are fantastic. The thinking within the company, though, was really quite immense. The part of the business I worked with was called Bacardi Global Brands. So Bacardi, as well as owning Bacardi, owns Grey Goose and Bombay and Dewars
Yep.
and lots of. There's 8 global brands that they had, and that was kind of our remit. They also have at the time, 255 local brands. So huge company. I think when I was there, it was 4.6 billion
Mm-hmm.
turnover. And since then, the last time I checked, it was like 6 billion. And it's still family owned,
Yeah.
which is an
Private.
amazing thing to have.
It
But
really is.
the big thing that drove what we were doing was there was a belief that the spirits industry was going to go through a class action lawsuit, in the same way as tobacco had done 20 years before.
Ah,
So
okay.
everything that was driving us was making sure that we were consistent, making sure that we were compliant, making sure that there was legal drinking ages pages in front of it. And because at one point they thought about going to an IPO, they wanted to have the consistency required for an exit, essentially an IPO exit, so that if an investment banker recommending buying Bacardi as part of an IPO, keep in mind this is like 15, 20 years ago,
Sure.
they would fly from Hong Kong, they would go to Berlin, they'd go to London, they'd go to New York, they'd go to Los Angeles and wherever else, and Bacardi would be consistent.
Mm-hmm.
And back in the day, the brand was consistent, the logo was consistent, but how local markets activated that brand was very different.
Yeah.
And we needed that consistency so that actually what you got was, when you viewed Bacardi, it didn't matter where you were in the world. You knew what Bacardi was. You could see the logo. It was consistent. You just knew what you were getting. It was a premium
Mm-hmm.
product. It was exactly what you wanted. And that's very much what drove it. My challenge at the time was, they had made a decision that some of the local markets were doing silly advertising that we didn't want to do for the consistency reason. So we took the TV advertising budget off of most of the local markets.
Mm.
But all that meant was they all jumped into digital. So
Yeah.
I suddenly became the gatekeeper for everything that was going on digitally, and they did do
Gotcha.
some really bizarre things. I'm not going to tell you. Some of them are so bizarre. I'm not even going to tell you on the
Yeah.
podcast because they are quite rude. But that consistency was a huge part of what I had to bring to it. So it was allowing the brand directors, the marketers, to be innovative, to be driving the boundaries of what you could do within spirit advertising, and the laws are very different.
Yeah.
And driving all that through the digital channels while making sure it was consistent and it was all kind of pulled together. So it was a fantastic role. I genuinely A fantastic role. The people that were there were just second to none. They're some of the best marketers I've ever
Yeah.
worked with in my life. We worked with some of the best agencies in the world. We had a really smart, I think anyway, a really smart strategy. And it wasn't mine. I inherited it from the previous team that was based at Washington, D.C., which was rather than going to some of the big companies, have 8 or 10 smaller companies, because you get a better service, the innovation was better, the creativity was better. And as long as you had a big enough roster, then you were fine. What I did find there was, which was a challenge for us, was, and I got worried about this, I put in place steps to rectify this. We found that we kept going back to some of the same agencies. So suddenly we were 50% of an agency's revenue. So if we pulled their work, that agency was just knackered. The revenue would
Wow.
plummet.
Yeah.
So
Yeah.
we purposely restricted how much work we could put into any one agency. And if they
Yeah.
wanted more work from us, that's cool. Go away and get
Yeah.
2 other clients and we'll give you more work as well. So
Yeah.
we were happy to help them grow, but we just could never be above, I think it was 30% of their revenue at
Yeah.
any one point.
Wow.
Otherwise,
That's
we were just too controlling.
yeah. That's amazing thinking too on the family's part, or the company's part, to be thinking about their vendors in that way.
Yeah,
I
no,
like that.
completely.
Well,
And after I left, they kind of then changed all of that strategy, and I can't remember who they went. They went to WPP or Omnicom or something, and just kind of did it
okay.
all. But that's just the cycle that advertising goes through, isn't it?
Yeah, yeah, yeah. Well, I appreciate you sharing all that. I mean, it's super interesting to hear about Bacardi and a lot of the similar, things I've heard through documentaries or reading about the family and everything. So I think that's super interesting, especially being in Miami, not far from here, where I'm located. But all of that is great as a good kind of precursor to this conversation and good background. So as we kind of jump into our actual conversation of valuation to exit, let's start kind of broad. Like, what are you seeing in the market right now for companies that could have successful exits? I mean, I know that there's boomers that are trying to sell because they, don't have successors in their companies, small and mid market. You've got, mid-size acquisitions that are happening. You've got the election coming up, and you've got, the economy with inflation. There's so much that's going on. I mean, I'm curious to see your perspective on exits right now.
Wow, that is such a broad topic. But
It is
my
very broad.
view is
Yeah.
very broad. My view is, and I do keep a little bit of an eye on this. I'm not plunged hugely into the data and the trends, but from what I'm seeing, the boomers exiting, there is a whole subcategory of people who want to be a startup, but they're now being encouraged to not be a startup, buy something from a boomer, buy a previous
Yeah.
business and grow it. And I think there's a lot of value in that. There's a lot of
Mhm.
credibility. I can't remember what the name of the book. There was a famous book that was done like 10 or 15 years ago that started this kind of thinking. But you
Mhm.
literally just go onto Twitter and you'll find 8,000 people all kind of recommending how you go about this and why it's a good idea. And it is genuinely a good idea. A startup is a really challenging thing to do. It takes
Yes.
much longer than you think. You need perseverance. You need to
Oh,
dig deep
so
and get
much.
grit to keep it going. So actually buying a successful business that may just be small, but you can buy it. The other thing with buying a business from a boomer, you can tend to do what's called seller finance. So you can buy it
Hmm.
without actually paying for it, because the
Yeah.
seller will kind of allow you to pay it over your profits in the next year, 2 years, 5 years. So you can do that. So with very little money down, you can actually buy a business that's quite valuable, and then you put your sweat and blood and tears into it to grow it and make it successful. And
Yeah.
I personally think that is significantly easier than doing a startup. Startups are great
Hmm.
if you want to do something that's truly innovative and no one's done it before. That's
Hmm.
why venture capital is venture capital, because it's taking that risk in small startups,
Hmm.
but the reward has to be big for those guys. And then the other part of it is the bigger part of it, the private equity guys doing exits.
Yeah.
So for me, there's the different layers depending on the size of your business, the category you're in, things like
Hmm.
that. It's challenging out there. It is hugely challenging out there. I don't care who you are, it is challenging. But the one thing that is getting funded now is if you've got a good business. If you've got a
Yeah.
good business, people will give
An
you money.
actual valuable
An,
business in the
an
market. Yep.
actual valuable business. The
Hmm.
people who are struggling at the moment are the people who have got half of a good idea, they've half
Hmm.
executed on it, they've not
Hmm.
quite clarified it, not pivoted possibly, they've not quite
Hmm.
got the product market fit, but they've got a good idea. And
Yeah.
The founders themselves, can see that it's a good idea, and I can see it's a good idea, but it's just not quite ready for someone to say, I'll give you X amount of money to buy it,
Yeah.
to take it on, to move it forward. So it's that's what I'm seeing is there's lots and lots and lots of businesses out there that are fantastic businesses, but they're just
Yeah.
not quite ready to do the exit. But if you've got a good business, if you've got some revenue, if you've got a clear product market fit, if you've got the wherewithal, depending on what size you're at, people will give you money. There is
Yeah.
more than enough money out there. It's just that it's being very, very cautious about where it's going and what it's investing in.
Are you seeing this when you say people will give you money in general? Are you seeing that coming more for roll ups, acquisitions, private equity? Is there something that stands out to you more so than another?
I tend to work with private equity more than anything else. I
Okay.
do some work with VCs. I'm finding that private equity is going well. I think
Mm-hmm.
private. I know I work with a couple of funds. One fund's just raised another. I work with a couple of private equity firms. One has
Mm-hmm.
just raised 1.6 billion as their new fund. Another one's raised 3 billion. It's actually just under 3 billion, and I do like to point out it's like 2.95 billion. So I
Yeah.
like to point out it's not 3 billion because it upsets them. So there are LPs are out there giving money into these funds, but
Yeah.
they are being very particular about which funds. If you're a mediocre fund, it is challenging because you've not
Mm-hmm.
got the returns that the LPs are looking for. But there
Mm-hmm.
is more than enough money out there. They are just being very selective of which private equity firms they're putting it into, and then how those private equity firms are actually deploying the cash that they have. But that's
Yeah.
two funds that I work with, and that's the best part of 5 billion they've got to deploy. They've got to deploy it in the next 2-3 years. So
Yeah.
they're out there actually. In fact, one of them I know, I probably shouldn't, I won't say their name, but one of them I know,
No.
they raised a 3 billion fund probably about a year ago now. They currently have 6 deals in exclusivity.
Okay.
And they're not. I spoke to one of the guys last week, and he's kind of pulling his hair out. He's so busy. So they're not a big fund, a big
Mm-hmm.
team, but they've got a lot of money, and the money's there. But you have to be a good business. They're not just
So
giving it the dot-com boom of I've got an
yeah,
idea, let's give me money. That doesn't exist
not
anymore.
throw money at ideas. Yeah. On that point of being a good business, it's to me, I look out there and I see the same thing. I see a lot of companies that are kind of half baked and they're working really hard, but they're struggling. And it's in part it's because they're sort of an amalgamation of a lot of things they've tried, and they don't really have a solid direction. And so I'm curious, do you think part of the reason is that, but also because companies leadership they're not focused on an exit. They're not focused on building their valuation or the value of their company towards an actual sale point.
I think there's a lot of companies in that position, and I think a lot of companies and a lot of leaders tend
Mm-hmm.
to fall into that. We're getting involved in the day to day. We're running the business, and we're running the business, and we're running the business,
Yeah, yeah.
forgetting why we're running the business. What's
Mm-hmm.
the objective? Where are we going to? Do we want to go to an exit? Do we want to get to the next level? Do we want to get to 10 million or 50 million or 100 million? And they fall into this the day to day busyness
Mm-hmm.
takes over from the strategic, the prioritization, the growing the business. And very often it comes from, I personally think it comes from a bit of experience. A CEO should not be running a business. A CEO should be leading a business. And if
Yes.
you as a CEO are running the business, you need to go out and hire a chief operating officer. They're the guys that are running the business while you're thinking much more strategically. Do we expand
Yes.
into the West Coast or the East Coast or Europe or wherever?
Mm-hmm.
That's the CEO's job, is to lead the business. But if you spend all day, every day running the business, you don't have the time. And it doesn't make you a bad person. It's
No. Yeah.
understandable. But you
Yeah.
need to elevate yourself above that and think, hang on, what is the objective here? I've got 3 founders, I've got 5 investors. They're all
Mm-hmm.
expecting to exit the business in 5 years' time and get this big number. And
Mm-hmm.
I'm busy worrying about an operational issue or a marketing issue, or is that you need to elevate yourself within the business to focus on what the objective truly is, and
Yeah.
keep that in mind. Have a
Yeah.
reminder in your calendar every Monday morning that
Yeah.
says the objective is exit in 5 years' time. Do
Yeah.
something to kind of keep that. That's your role. Your
Yeah.
role
Like a
isn't to get
countdown or
into the
something. Yeah.
weeds.
That's what
Yeah,
I'm seeing
countdown.
too. I see like CEOs that when I meet CEOs that are in the business like that and they're operating and putting out fires every day, generally what I see is that they don't have a vision, because those who do have a vision are generally executing against that vision, and they're not going to get pulled into the fire because they're more passionate about the vision.
Yeah. That's 99% of it. I do see the occasion when they have a really great strategy deck, and that was probably why they got the investors involved in the first place.
Yeah.
And it's
Yeah.
kind of
Yeah.
like, yeah, when was the last time you read that? When was the last time you updated?
Yeah.
When was the last time you told your entire team that this is how we're progressing against it and this is where we're going next year?
Yes.
And it's not that they don't have it all the time. Occasionally they don't. But it's the fact that it was done for a purpose and then thrown away, as opposed to done for the North Star. What are we trying to
Yeah.
get to? This is where we're going. Every month we should be telling our investors how we're progressing against this. We should be telling the employees of, we had a bad month, we've not progressed as far as we wanted. We had a bad month, we've taken a step back, but we're going to
Yeah.
use that
But
strategically
we're
to
still
move
locked
forward.
on.
But
Yeah.
this is where we're going. Because I think if you've got that strategic vision of what you're trying to get to, it's guaranteed you're going to get pushed off the rails once in a while, but you know where to come back to. You know how to come back because you've still got that North Star, that vision that you're trying for.
Yeah.
And far too many people that I see are working in the business. They're putting
Yeah.
out fires, they're firefighting, they're dealing with issues. All very important, just not your job.
Yeah, that's right.
Hire someone to do that stuff for you so that you can keep the company on track.
So when should CEOs or owners start thinking about getting their company ready for exit?
Given what we've said about it's easier, I'm not going to say it's easy, it's easier to get funding for your business if it's a good business. Everything you do should be working up to an exit. Having an exit in mind, you don't have to exit, but having an exit in mind is a really good discipline for, are we doing the right thing? Are we operating as effectively as we could be? Are we engaging with our consumers in the right way and giving them products and services that they need, that they see value, and do our customers want to come back? So having the exit in mind, or a fundraise or an M&A in mind, whichever flavour of exit you wanted to think about, it's a good way of giving yourself the discipline. But if you've not been there, today's the best day to start. If you are thinking about it, to maximize your value, to maximize the exit you get, I would always say give yourself 2 years, because there'll be some fundamental things that you want to change as you're going through your business, and it will take a bit of time. You can do it in fact, I'm not even going to say, I was going to say you can do it in 3 months, but you can't. If you do it in 3 months, you're going to get zero value for your business. It's going to be someone just coming in to pick up the pieces and to move forward with it. Typically, an exit would take 6 months to go through the process, figure out where you are, and get someone to come in and actually kind of acquire you in some way. It can be done much quicker, and it depends on who you are. But if it's going to take 6 months just to go through that process and due diligence and things, you need to be giving yourself 3 months, 6 months before that to really give yourself a chance.
I mean, that's much quicker than I thought. I thought your answer was going to be years, of sitting down and retooling. And I mean, I guess it depends on where you're at, but that's pretty quick.
Yeah, I mean, it's my experience. I think if someone came to me and said, I want to exit my business, and I said to them, great, we can start thinking about an exit in 2030. They're kind of go, oh man, that's not where I am. I'm just
they won't. They just want to get out. Yeah, at some point.
I can last a year, maybe 2 years, and then you got to give them the bad news that, well, we can exit you in 2 years, but you've got a 2-year earnout. So you're going to have to, whoever's buying you is going to want you to be there because you are the business, you're the knowledge in the business. They want that handover process. So you're going to have an earnout that's there. So you're committing to 4 years to exit your business in a year or 2 years. It's going to be that type of timeline. So the more that you prepare yourself earlier, and to be honest, the other good thing about that is if you're the CEO that is working on the business, not in the business, it's easier for you to extract yourself. They probably want you to hang around for 6 months, a year, and then think, why are we paying this guy?
Yeah.
The CO's there. He's the one that's running the business. We've got a new vision that we want to implement anyway. So
Yeah.
thanks a lot for 6 months, but it's great.
Yeah. That'd be
Um,
ideal. Yeah.
yeah, and it doesn't always work that way. Very often I find, especially with institutional buyers, so VCs and private equity,
Hmm.
they're happy to pay a bit more of a premium to have you around, even if you're not really
Hmm.
adding too much value for too long. The safety belt that comes with it, the security
Yeah.
blanket of you're still there just in case,
Hmm.
that's always a good thing for them. And that means they're paying your salary and maybe not getting value from you, but you get value from it,
Yeah.
you're getting your salary, and they
Yeah.
get the comfort of you being there.
Yeah. 100%. All right. So now let's get into your thinking about, your framework of, like, take us through your process. If when you work with a company to sort of prepare them for an exit, what's the process that you take them through? What's the thinking that you would want to deploy?
Okay, so I don't have a process. Is
Okay.
the simple truth of it. Everything I do is bespoke to the company I work with.
Oh,
I
wow. Okay.
do
All right.
kind of, I do have a kind of mindset that I go through though when I'm doing, and the first part of any of this stuff for me is discovery.
Yeah.
And that's where the most of the process is coming from, or the mindset's coming from. And you start with, I'm not a finance guy. I know enough about finance. I'm not a CFO. I'm more of a commercial
Yeah.
guy than a CFO guy. So I tend to start with the commercials. What are you selling? Who are you selling it to? Where's your profit margin? How's it all
Hmm.
hanging together? And are
Hmm.
you selling something that someone wants to buy? Because I very
Fit.
often
Yeah.
find that within that world, just as a growth thing, it doesn't even have to be an exit thing. People
Hmm.
undervalue themselves. They undervalue their
Hmm.
products, undervalue their services. So you can very often get a very quick win there just by increasing your pricing by 10%. And your
Hmm.
customers would be delighted with that. I mean, they're kind of thinking, oh
Yeah.
man, I've had 5 years of you being incredibly cheap. Now I'm just paying what I should have
Yeah.
been paying all along.
Yeah. Right.
So you can look at that. So I always look at the commercials first. I then go behind that and I look at the finances, only because the finances are where you can find lots of the skeletons. Even if you weren't looking for skeletons, even if the business doesn't believe it has skeletons, the finances is where it's going to come out. You're going to find a
Yeah.
line in a budget somewhere, and it's kind of like, "What's that for?" I don't know. I've always meant to ask that. Yeah, I should go away and figure it out. Yeah, let's
Yeah.
do that before we get into due diligence then.
Right.
And then from there, I go into the operations, the people, the HR, who are key
Okay.
employees, who, if they choose to leave tomorrow, it would be sad to lose a team member, but they're not going to disrupt the business and things like
Yeah.
that. But essentially, the thought process in my head, I touch every part of a business. I look at
Yeah.
there's nothing I don't touch. And the one that's very often overlooked is customer service. I find people always overlook customer service, and yet they're the ones that are talking to your customers every day. It's like,
Hmm.
maybe you should be talking to them more often. But essentially, what I do is, during that discovery process is I do the type of due diligence I would expect an investor to do, so that I find it before they find it. And if I find
Yeah.
it, we can fix it. And
Yep.
if we can't fix it because it's 2 or 5 years to kind of change something, then at least we can get a story or narrative written about it. We can start putting
That's
in a
right.
plan. We've identified this is a weakness within our business. We,
Here's what
we've
we're
been
doing about
working
it.
on it for 6 months, but there's another
Yeah.
18 months before we've got it fixed. But do you know what? That's a great thing, because you're going to invest in us now, and you're going to get the benefit of this work in 18 months' time, and that's where it comes to grow.
So that helps me a lot, actually, when you saying that, because when you're talking about 3 to 6 months of kind of getting ramped up to sell, that time frame surprised me, thinking it would be much longer than that for your typical company who doesn't have all their stuff together. But when you put it that way, there are probably some key things that you're going to unearth that don't take 2 years to turn around. It's about the intent of turning them around, and
Yeah.
it's starting to work on that. Investors are going to see the truth in that.
Yeah, and part of there's a couple of dynamics in there. One dynamic is no one's going to buy your business if there's no upside for them. So if we've spent
Yes.
2 years improving your business and your business is now perfect, which doesn't exist, but say your business is
Right.
perfect, why am I buying your business when I get no upside? You're taking all the money off the table. I'm just ending up with your business, and I'm running your business, but I don't see
Yeah.
how I can improve on it and I want to have a return on my money.
Hmm.
I want to see something. I want to implement a better strategy, a different strategy. I want to attach your company to my other company so that between the two of you we can move forward. So any
Yeah.
investor has to have an upside. So if you do have a problem within the business that would traditionally be a negative, we can turn that into a positive by saying this is where you get your upside. We're working on it today. We've got a plan. We've identified it. This is where the upside comes from. We're going to sell it to you today, but you get this upside in 18 months' time. That's a really good story. So it means that anyone buying the business can see the benefit and they get some return on it. But the other thing then is depends on the level and the sector that you're in. What a VC will look for is entirely different to what a private equity will look for, which is entirely different to what your biggest competitor, who's 5 times bigger than you, is looking for in your business.
Yep.
So understanding what your exit strategy is and who's most likely to buy your business will help us understand what parts of your business we need to be working on, fixing any problems that we find, and where, when we are coming across this storytelling, this narrative of this is what you get out of buying my business today comes from, all of those things will be different. I very often talk about when you get into valuations, your business is a value, but the value. So if I'm buying your business is a value, has a fundamental value, and we can calculate what that is based on lots of different criteria, discounted cash flow, which I'm not a huge fan of, or a multiple within your industry, that kind of stuff. So I can value your business very, very easily. But if my plan is to take your business and attach it to my 2 other businesses, suddenly your business is worth significantly more to me than anyone else, because I'm going to be cross-selling my other businesses into your business. So I can increase your revenue by 40% the day I buy you.
That's right.
And so there's a value of your business and a value to the buyer of your business.
Correct.
And if
there's a financial value and a strategic value. Yeah.
Exactly. And if we can understand what that is, it can take me, I can change the valuation of your business within a few weeks just by changing that narrative, by changing that story that says, this is what my business has done historically, but as part of your organization, VCP, other competitor, other business, this is the value we would bring to you.
Yeah, that's huge. I mean, that's going to take you getting in there into the weeds and trying to determine who that buyer is so that the narrative can map. So there's a lot of digging that's got to happen for that to happen.
Yeah, completely. I very often tell people that, and this is a bad analogy, but it's the best one I've got. If you're going to sell your house, the first thing you would do is remove your furniture and you'd stage it. Because it's still your house. You've not fundamentally changed your house. You're just presenting it in the way that appeals to the best buyer who's going to give you the most money to sell your house. That's what I do with businesses. I'm not changing your business. Sometimes I do because it's the right thing to do for your business. But I'm staging your business the right way for the best buyer to come in and give you the best price for your business. And ideally, I would like a year to do that, because sometimes I do want to fundamentally change some parts of your business that aren't working as well as they could. But that's just good business. Other times I can do that in 3 months' time just by changing the narrative, changing your strategy, changing the vision that the business has. And that will appeal to a buyer in a different way.
Yeah, it's so interesting. I love it because I have a lot of thoughts swirling around in my head, but we got to end this here pretty soon. So let me ask.
Wow.
Oh, I know. Maybe we'll have part 2 of this. I would come back.
Cool. Yeah.
What's the one thing right now that maybe a mid-market company that wants to exit, what can they do to improve valuation? Like, you go into companies all the time. What's the one thing you see that people could just do?
Well, first of all, the one thing that everyone is doing at the moment, if they want to exit, is they're focusing on EBITDA. Every company is looking at EBITDA, and that's great. But you're not going to influence your EBITDA in a significant way in the next 3-6 months. It's going to be 12, 24 months before you do that. So keep doing that, but that's a long-term play. The one thing you can change is what we've just spoken about, which is your vision and your strategy.
Okay.
Where is this company going? And if you can show that you're in a marketplace where the total addressable market's $1 billion, if you can change that by pivoting your business and now suddenly the total addressable market's 10 billion, hang on, that's more interesting. How do we get there? So let's change the strategy to slightly describe the business in a different way that says, actually, we're going after this 1 billion marketplace, but as soon as we've got halfway down that, we're then going to start the second 10 billion marketplace. suddenly your business is becoming much more interesting. So that vision, that strategy, and essentially it's the staging your house. It's how you stage your house will fundamentally change your business. So if you think about it in the most simplistic terms, most valuations are the value of your EBITDA, how much money you make before tax and amortization and things.
Depreciation.
The depreciation, that was the word I was looking for. So that's a number. And then traditionally, depending on what sector you're in, it's a multiple. If you focus on the EBITDA number, that will take you a while to get it. If you focus on your multiple number, the multiple is never a number, by the way. It's always a range. So if you're in marketing services, it can be anywhere from 4 if you're kind of small, or if you've not got as much recurring revenue in your project base and stuff, up to 6 or 8. I do know one business that I've been working with that is up to 12, and that's unusual, but they've got a really unique business, and that's cool. So if you focus on the EBITDA number, it will take you a while to get there. If you focus on changing all the narrative around about your multiple number, I can take you from 4 to 4.5 in a few weeks. I can take you from a 6 to an 8 in a few months. And suddenly you're talking about, hang on. So what you're telling me is I need to double my EBITDA number in 3 months, or I increase 1 point onto the multiple. Let's focus on the multiple.
Let's do the multiple.
I can do that. I can do that quickly. And that's where the staging of your house comes from. If you know what the investors are looking for, if you know what they are willing to put their money behind, whether it's a VC, private equity, or a strategic buyer, if you know what those things are, we can tell a story that will increase that multiple quite easily and quite quickly. It doesn't mean you need to change your business. If I say in your multiple, we're expanding into Europe, and the investor says, "Oh, great! Have you got a plan to expand into Europe?" And you go, "Well, no, we just spoke about it last week. We've not done anything about it."
Yeah.
We do need to have some substance about it. So it's not just a case of a new story. It's making sure there's a new story. It's making sure it's a credible story. It's making sure that you're going to pass due diligence with that story. So you can't just kind of go, man, we're flying to the moon tomorrow. It's great. I'm a 20 multiple.
Yeah.
There needs to be the backing around about it. And that's kind of what I do. I come in, I help you do the new story. I help you change the multiple. I help you do the staging of your house. Then I make sure through the discovery process I'm doing and preparing you for due diligence that actually it's a credible story. It's a story that people will understand. It's a story that people will recognize that you're best placed to deliver on. You've already started that part of the journey, so it's not pie in the sky and you can move forward. And as one of the parts of the business that I do, that improving your valuation and getting ready for an exit, that's a fundamental part of it.
Love it. This has been very interesting and uncovered some new ideas for me. So I appreciate that. And thanks again for coming on. If I want to send people your way, where do I send them?
Generally, the best place to find me is LinkedIn. I have a website, which is bletchleygroup.com. I'm currently changing it at the moment, but LinkedIn, you can always find me. You'll see a face not too dissimilar to this one. I'm Jim Stevenson. So LinkedIn, Jim Stevenson, you'll find me. And if anyone's got any questions, I'm always happy to talk to people. If I can help advise, if you want to employ me to do your staging of your home, I'm happy to do that as well.
Yeah, I think it's for people that are in the market right now for wanting to know more about valuation, thinking about exiting, 100% would think it's a great thing to have a conversation with you and talk more about it, because it's really reframing your mind about your business and where it's headed, so it maps to your buyer and understanding who your buyer is. It's just marketing your company to a new market versus your product to the market that it's marketing.
It's marketing 101, genuinely. So when you started off this conversation talking about my work at Bacardi,
yes,
this is marketing for businesses, and it's just understanding your buyer and making sure that you've got product market fit in the simplest terms. So as long as people are willing to accommodate my Scottish accent, I'm happy to talk to them.
I love it. Okay, well, we'll send them there. And thanks again. We'll definitely have you back and do another part 2 of this.
Awesome. I'm looking forward to it. It's been great chatting, Lee.